which is really good.
Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray. My guest today is Peter Moss. Peter works at WiMAC Capital Corporation. He's been a pioneer in financial services and in prominent technologies for 38 years. Wow, kind of intimidating, isn't it?
Old timer.
For 15 years, he's worked at WiMAC Capital Incorporated as an agent of this innovative Walnut Creek-based mortgage broker. In 2012 alone, his three-person team closed 154 first mortgages for his individual clients and through applications originated by other financial advisors statewide. This volume is enabled by a unique partnership method that includes WiMAC's cloud-based secure web system to enable financial professionals to originate loan applications and gather required data, forms, and signatures for approval. Being close to a client is a wonderful thing to streamline the loan process, and WiMAC, as most tech firms do, protects its unique methods with U.S. patents, including 5 that have been issued. Compliance of this process with regulations has been reviewed by the federal government's HUD group and 2 California state regulators. So I could sit here and introduce Peter for a long time. He's got a lot of accomplishments. But I will tell you, I've known him for quite a while. Peter and I actually work on clients together, and he's very knowledgeable in the mortgage business. That's why I asked him to be here with us today.
Excellent.
This interview is taking place on October 9th, 2013, with the Dow Jones Industrial Average about 14,700, beginning to fall sharply. Why? The government shutdown. Hopefully by the time that our viewers see this, that will be resolved. But anyway, it is having an impact. We need to say, as a disclosure, WiMAC's NMLS number is 18766, and Peter's is 298243. It's just a required disclosure. WiMAC is licensed by the California Board of Real Estate under number 011212628, and Peter's Board of Real Estate number is 298243. Peter, also, first, I want to make it clear to our viewers that you're not an investment advisor. Advice you provide is coming from you individually. It doesn't necessarily represent the position of views of WiMAC Capital. And before getting into the details, I want to explore your concept of the big picture as a guide to refinancing as well as related aspects of personal financial management. So first of all, Peter, let me say thank you and welcome as a guest here on Financial Insider Weekly. So let's just go ahead and with our first slide, I guess, right?
I'd like to get into your mortgage, which is a lot different than most people really expect it to be, and that's what the slide leads into. And so we're going to cover some fairly unusual aspects of a mortgage, thinking about it differently, which most people should do and most people don't. And also we're going to talk about the recent changes that make your mortgage different in terms of refinancing specifically.
So Peter, if you look at me, I know it's tempting to look at the slide, but just look at me as best.
So if we can have that next slide, one of the major changes now is that values obviously have been coming up in the last couple of years fairly sharply in the last year and a half to 2 years. What's not so obvious is that trend has really slowed up. Mm-hmm. And so while you will hear a lot of realtors hyping, how values are going up, but this is your opportunity, to some extent they have a very good point in that we are probably cresting. I don't know when we're going to actually start going down again, but I do expect no later than 2015, perhaps next year, we'll be seeing values going down. And that, as we know, is somewhat driven by the stock market. So take that as you will.
Yeah. But also it depends a lot on the area that you're talking about. So there's some areas that are hotter than others.
It's very true. For example, even with the decline we had that was so sharp, 2007 through 2010, the city of San Francisco itself stood up very well, and a lot of the hot areas in Silicon Valley did extremely well, despite the whole ocean going down. But there are a number of other things that change also, and if we can go to the next slide, we can take a look at a major factor, obviously, for refinancing. If we go to that next slide.
Okay, I think he's there already, so
okay.
just assume that he's there.
All right. The next slide shows last 10 years in interest rates, which obviously from a mortgage broker standpoint, myself being a mortgage agent, is critical. But it also shows the squiggles. Rates have a tendency to go up and down like an oscillator on a scope. And so what you have are opportunities when rates dip to refinance, and then they go up for a while, and you quote-unquote missed the boat, at least for a little while, and then they go down again. And that trend got to an extreme just recently in May, where they started going up and didn't really start going down until the beginning of September. Here we are at the beginning of October, and they've started to go down again, which is good, but they haven't gone down that far. And we went to very low levels. A lot of people thought we'd never get there again every time this happens. But truth is, we're in a trend that began, as the slide kind of implies, a long time ago, actually in 1981. And my crystal ball says it's not a trend that's going to stop for at least several more years. Will we see 10-year fixed rates in the sub-ones? I think so.
Really?
I think that probability is there.
That would be amazing.
Let's go to the next slide, and you can see exactly what I was just talking about, and that rates in the last year plus, shot up, and they shot up in May in a very spectacular fashion, and now we're just, as you can see from the far right-hand part of the chart, just starting to slide downward again. Going to the next chart, we can see part of what's going on here at the macro level, and this is as macro as you want to get, because the next slide goes all the way back to 1950. So historically, you can now see how rates, as measured by the 10-year Treasury, ran up, but you also see another number, which is the M2 money stock velocity, which is really the oomph in the economy. And you can see how we had tremendous productivity, which that is illustrated by, going through the 90s and into 2000, when it very abruptly fell off and has slid very, very dramatically, which does not bode well for the economy at all. So what the Fed is doing, as we've somewhat noticed, is they're pushing on a string. They would like to get the economy going, but lenders are not lending, at least the bankers who are doing industrial lending. And so smaller companies are not spending that much because they're not optimistic. If they were more optimistic, the economy would be doing a lot better. But what you're seeing is effectively the velocity of money keeps on going down, and that's very scary. And that's why I think rates will continue to go down, because that is a huge battleship that doesn't turn quickly.
Wow.
Going to the next slide to illustrate where we might be going is a even longer time period going back to 1600 and so, which seems like very ancient economic history, but it's important to keep the global perspective, and that's where I like to start. And the global perspective on this chart basically says that we're going to have deflation, which we have not had since the Great Depression. And we're quite frankly more used to that in the history of the United States than we are inflation. It's definitely been the influence of the Federal Reserve Board that's tried to avoid, after the Great Depression, deflation or even disinflation. Now, we've had disinflation since 1981 with the Volcker bubble burst, and that has been very favorable for everyone. You know, we've had a bull market since, off and on, since 1982 into 2000, and now we're having the worst part of the deflationary cycle, which is when we get very, very low, unhealthy low rates, where lowering rates by the Fed is not possible anymore because they're as low as they can go.
It's zero, basically.
And so now you're seeing the pushing on the string effect,
Yeah.
and so the Fed's tools are minimized.
Mm-hmm.
So that's the big picture. So that's where we stand now. But in terms of your mortgage, which is why I'm here.
Did you want to cover this last slide, which is the federal government total financial
Okay.
assets? Or?
Yeah. What, in fact, is not obvious
The pie charting.
is the financial assets, which are obviously a small fraction of the total federal government assets, but they are the financial assets of the government, are 42% as of second quarter, at least, in student loans. It's just absolutely scary. Those who have student loans realize how slowly those get repaid.
Right.
And those who don't have student loans should take a look at this pie chart and be aware that our own government is into a fairly illiquid situation in terms of almost the majority of its financial assets, which is one of the maladies that faces us.
Okay, so then I guess we're done with our PowerPoints here.
Now we can just have a conversation.
Okay, good.
Okay. So the big picture is, for mortgages at least, three factors, and I break it down to three factors. One is timing, one is keeping things simple, and the other one is this theme we just talked about, the disinflation. And so we've covered that fairly much, but let's talk about timing and the real basics, blocking and tackling. People probably don't think of Warren Buffett as a market timer, but he is to an extreme. He buys low very carefully and sells high. And it's interesting, right now he is selling. When he made recently, at least in October, it's come out that he's made $10 billion off of loans and monies advanced to distressed or acquisitive companies in the bubble bursting time frame of the housing crisis. Now, some of these were industrial loans to people like Mars, the candy bar people who wanted to make an acquisition. But nonetheless, you don't get money from Warren Buffett cheaply, at least in terms of large amounts of money, which is the only thing he's very interested in. It has to be material to him. And so you too should emulate him, and then we'll talk about how you should emulate him in terms of managing your personal finances, specifically your mortgage. So what Warren does, and he's a great bridge player. My mother was a wonderful bridge player, triple life master. So I have to respect his astuteness and the way he plays his cards. What he does is when it's opportunistic, he does his financial transaction, and that's exactly the way you should handle your mortgage. I'll step aside of other financial transactions, but certainly your mortgage. So most people don't realize that they shouldn't just go out and refinance. They should either work with someone who is watching the market very carefully or should do it themselves. Either way works. But not many people have the time to watch interest rates as closely as the people who are in the business. The reason for that is things have changed. Used to be the best sophisticated investor could do, a sophisticated individual would be to refinance with no points and no fees. The Federal Reserve changed that. In April of 2011, you can now make a fair amount of money by refinancing, believe it or not, if you work with a mortgage broker, and only if you work with a mortgage broker. It was sort of a bone they threw out to mortgage brokers who otherwise were fairly well clobbered in the last several years in terms of additional layers of regulation that were put upon them. So, for example, today, and I just worked on the reconciliation, which we give to a client out for every loan we close. I had a client who did a $625,000 refinance, lowered her rate 0.5%, and by the way, made $3,770 on the transaction, gain for locking that rate and closing that loan after all her fees were reimbursed.
Wow.
So, timing is important. Locking is important. You just don't want to get that mortgage and get that great rate and close. There are more considerations now than that. The other thing is breaking things down into a simple fashion. mortgage are something that most people don't realize, and I kind of illustrated that. When you do a mortgage, whether it's a purchase or whether it's a refinance, you're actually issuing a bond secured by your house.
Mm-hmm.
And what I just described was a refinance. But what you're effectively doing is the same thing as a corporate treasurer would do, and that is he's trading one bond for a lower rate bond.
Mm-hmm.
He can book a gain doing that as a corporate treasurer, and you as an individual now can do that too. Mm-hmm. It's a brand new concept. So I wanted to make that point.
Okay.
But going back to our slide about housing begins to rebound.
Don't worry about the slides at this
Okay.
point.
Other things have changed in the world of mortgages.
Bear in mind, we've got about 13 minutes left, so
Okay.
we've got a lot to cover here.
All right. So
let's really focus in on these changes. And
there are
so
many
forth.
reasons you can refinance now that you couldn't before.
Uh-huh.
Obviously, the obvious one we just talked about was we can now look at more equity in most cases. There are a few areas that are still depressed, but even they have bounced a little bit. So
the value of the home has gone up, so now people they have room to refinance.
Yeah. Your mortgage professional may have said to you, look, you don't have enough equity. I've looked at the comparables, and the recent sales don't support having an 80% loan to value. You may have mortgage insurance right now. You may have an FHA loan.
Mm-hmm.
You have the opportunity now with values coming up, and they're not likely to go down dramatically in the next months at least, maybe years or two. You may see a dip. But now's the time to revalue your home in terms of talking to a mortgage professional and seeing, do you have the equity to either get rid of mortgage insurance or to refinance where you were stuck before because you wouldn't want mortgage insurance. Now you're under 80% loan to value, and you can do that. Mm-hmm. Mm-hmm. So that's one change. There are a number of other changes. Self-employed individuals. We have a lot of self-employed. In fact, over half our clients are self-employed. We work with CPAs primarily, and they tend to have self-employed clients. So one thing that's a major change for them is in enabling a lot of them to refinance. A lot of them had a tough 2011. Right. So with their 2012 return now, it's higher. Mm-hmm. They only need 1 year's return, which is something brand new. Okay. Last year you couldn't do that. 2013, you can now use your 2012 return. If it's proportional to your debt, you can refinance, and assuming you have the equity. So that's one change. Another change, people who are retired or even approaching retirement and are eligible to pull out money from the retirement accounts. But because they're semi-retired, their incomes may be scaled back a little bit, or they are retired and they're only on Social Security and maybe some small pensions, or not even that. They may have some IRA withdrawals. Any account they have not touched for IRA withdrawals, there is a new rule that allows them to pull virtually the money out there in 1/36. In other words, 3 years worth of amortization of whatever they haven't touched yet can be counted as income. And of course, there's a haircut if those are in securities, but if they're in cash instruments or liquid instruments, there's no haircut at all. So they get to count that additional asset as if it were being withdrawn, even though it's not being withdrawn. So that's a major additional change.
Yeah.
Here's another thing. Rates go down. And when rates go down, people qualify who didn't qualify before, because their payment will go down with a lower rate. So that's one issue. We have a lot of people who had a lot of properties, who invested heavily in real estate, had a lot of debt, didn't qualify. But we have one client, for example, we refinanced 2 rentals and their primary home, and we did that only because rates are lower. She would not have qualified for the first refinance with the old rates that were in effect a year and a half ago. With the lower rates, she now did qualify, and so we're refinancing 3 times, lowering every rate she has. And believe it or not, we're refinancing 2 of the 3 properties with no points and no fees, even one of the rentals, which you now can do. We can also do a small mortgage. A lot of people think, I've got a $125,000, $150,000, $175,000 loan. I can't refinance that with no points and no fees. You know, why should I bother with it? We, not that long ago, closed a $120,000 mortgage with no points and no fees. Everything was reversed. They actually had a small gain on it. So times have changed. Rules have changed. People should talk to a mortgage professional, particularly a mortgage broker or mortgage agent, who might be able to help them with that. Another new change, lots of changes. Jumbo loans.
Yes, jumbo loans.
Over 625,500. That's the
Right.
magic number, at least in the Bay Area counties.
Right.
People with a mortgage larger than that really suffered rate-wise and also had tougher qualification standards, dramatically so. That has now changed too. So what has happened is syndicated money, Wall Street money if you will, has come into that market. It hopefully will go into compete with other mortgage rates. And so those rates are now, in many cases, very comparable to the larger conforming loans. And so the ability to do a no point, no fee jumbo loan exists now, where a year ago you couldn't dream of it. Qualification standards, you don't have to have a year's worth of liquidity anymore. It, depending on lender, is a lot less. So the hurdle to do a jumbo loan has gone down as well as the rates. So that's a major development.
So this is sort of, it's a return to the securitization that sort of died out after the crash.
This is more prudent securitization because the numbers make sense. We've always had a large number of jumbo borrowers, but in many cases they qualified based on quote-unquote stated income. These people are qualifying on real income, tax return income. So that's a good event that's come about. Now, on the other side, the pendulum swings. So based upon the subprime era, we're still getting tightening. And one of the last things we're seeing is something called QM, or qualified mortgages. And unfortunately, here we're talking in October, and these rules may not be finalized until November, even December. They're supposed to go into effect in January. We suspect strongly some of them will, such as the combination of the good faith estimate and the truth in lending document. Those will get merged. We think it still will happen in January. We think other things that we're talking about in terms of qualified mortgages or mortgages where the lender receives what's called a safe harbor, so they're more likely to be aggressive about it because they meet the criteria not to be sued, not to have the mortgage put back at them if they follow the correct underwriting standards. Those go into effect. One of the negative things about that is there's a 43% debt to income ratio involved, income to debt ratio. So because of that, people who just squeak by right now in qualifying probably won't qualify after whenever this goes into effect, whether it's January or later in 2014.
Wow.
So people who want to refinance may want to accept a little higher rate to have the comfort of getting it done if, in fact, they're right on the cusp of not qualifying, and they know that, and their mortgage professional should also know that.
Okay.
So that's important.
So we only have about maybe 4.5 minutes left.
Covered a lot.
Maybe you can talk just briefly about reverse mortgages.
Okay. Historically, reverse mortgages, both from the people who have been doing them, which is the FHA, and from the people who have been receiving them, the elderly, over 62, have been a very poor deal, sometimes to an extreme. You have mortgage insurance, you have heavy fees going into them. They are and should have been, over the years, sort of the loan of last resort. Relatives who, in many cases, are in the position of going on the loan with the elderly relative probably should have done that in retrospect, even though they thought it might have been extending themselves, both from a perspective of your area as a CPA, tax planning, and from a perspective of estate planning. It might have been smarter than either losing their home or being put into a position of selling the home on a very expedited, almost emergency basis to satisfy the lender. On the other side of it, the FHA has been asking the government for billions of dollars in terms of their losses on these programs because values went down a lot, and also because they found that people who did not really have an understanding of what they were getting into or were too old to understand what they were getting into walked away or defaulted at a level they did not anticipate. So the losses in that program have been very high, primarily because people going into a nursing home suddenly get a notice of foreclosure because they do not live in the home anymore, which is one of the requirements of the program.
Yeah, so that's the big thing. A lot of people don't realize with these reverse mortgages is if you're out of the home for more than a year, basically the bank can call the loan and can foreclose.
And they do fairly aggressively.
Yeah. We probably only have about a minute or so left. Do you want to talk at all about the HARP program?
Well, the HARP program as it exists has pretty much been taken advantage of by those people who were aware of it. There's a small population, I guess, who don't know about it. But what we're finding is a lot of investors in real estate have HARP properties, and they don't know that. They're not aware of it because they don't think about HARP. They think of HARP as a residential, primary or secondary resident program. However, the majority of the HARP loans we're doing now are actually rentals, which weren't enabled initially, but were later on in terms of being able to close them.
So this is where you can refinance a loan that otherwise might even be underwater?
A lot of rentals are underwater because they were leveraged heavily, and also they're in lesser income areas where the values have not popped up as much as they have otherwise. The other thing we're finding is we do a lot of HARP loans, and then we go further down the road, as that cartoon showed, and suddenly the client can refinance because they have enough equity where they didn't when they did the HARP loan. So the HARP loan in some ways is actually what it was designed to be, a Band-Aid until the market became healthy, and they're taking advantage of it. So it worked out very well for a lot of individuals.
Okay. Only have maybe about 30 seconds. Do you have maybe a final thought you'd like to throw out?
Well, again, think of your mortgage as a bond, one you can actually trade in for a gain when rates go down. That's a key theme that, again, is unconventional wisdom, but it's very important to think about, because in dealing with a mortgage broker, you can actually ask that mortgage broker to get a gain for you when you lock after all fees have been reimbursed.
Okay. Peter, thanks for joining me as my guest today. Really appreciate your insights related to what's going on in the mortgage area. Folks, hope we've given you a lot to think about. We'll see you next time on Financial Insider Weekly.